All attendees are in listen-only mode.
Welcome, everybody, to the next installment of the OurCrowd Teaching Tuesday webinar series. I run these every other Tuesday. It's an opportunity for investors from around the world to tune in and learn about different discrete processes in the investment field. We dissect everything from term sheets all the way to looking at different sectors. It's a chance for us to invite in experts as well. As you hear tonight, Andrew Heyer from Mistral Equity Partners will be joining us. We'll talk a little bit about him in a second, but just a little logistics. This will be a 1-hour session. We try very hard to stick to that time frame. We're sensitive to everybody's schedule, so you can get on with your day. We are recording this, and hopefully, Andy, will make these slides available to everybody as well. You'll have the opportunity to ask questions. So we're planning about a 40-minute presentation. There should be about 20 minutes afterwards. If you look at your GoToWebinar control panel, there is a section there that you can submit a question to us. If you send those through to me, I'll do my best to ask Andy the questions at the end of the session. We'll send out a link as well once we have the recording and the slide deck available so that you can review them on your own. I know a lot of people signed up and can't attend the entire session, so you will be able to review this on your own time. Other than that, without further ado, let me introduce first my partner, Elon Zivotofsky, who runs our deal flow here, to talk a little bit about Andy and Mistral Partners.
Thanks a lot, Zach, and welcome everybody to tonight's webinar, and especially welcome Andy. Thank you very much for taking the time to join us. So I just wanted to spend 1 minute sort of introducing Andy Heyer and the connection to OurCrowd. So Andy is the CEO and managing partner of Mistral Equity Partners, which is a private equity fund focused primarily or almost exclusively, if not completely, on retail and consumer space. I've known Andy now for a couple of years since I've been in OurCrowd. Andy's been in the investment business, I believe, for well over 25 years, focused on this space. Some of the companies which he's invested in historically are names like Celestial Seasonings, Jamba Juice, XpresSpa, Love Zack, names that actually probably many people are familiar with, frankly probably more familiar with as strong consumer brands than many of the OurCrowd technology investments. Andy, in addition, is an investor in OurCrowd, in the OurCrowd general partnership in the OurCrowd business, as well as in a number of our portfolio companies. Most prominently, Andy and his firm led the last round in Abe's Market, which is one of OurCrowd's portfolio companies. But almost in some ways more importantly, one of the things that we have built or trying to build at OurCrowd is what we call sort of our network effect or our crowd building effect, which is we've identified people in our network, some who are investors, some who are advisors, who have expertise in sectors and areas, in certain areas of investment that we don't necessarily have expertise in, or where we believe they can add a lot more value, both to our research and diligence process, as well as in terms of company building. And Andy and his firm are one of those connections, an incredibly important connection in the consumer and retail area. And so we actually connect with Andy and his team quite often when we're looking at companies where maybe we don't have the right expertise, or where there's a piece of the company where it's got a real consumer angle or a real retail angle, where we can get some real help from them. A couple of our recent investments fall into that category, companies like Clipfort and Aploy, where they're technology companies but really consumer or retail focused. And so Andy and his firm have been extremely helpful to us, really in terms of how to think about these companies and how to think about really the investment and the company building process for these companies, because it is different than many of the other types of investments we do. So we thought it would be great for Andy to share some of that incredible expertise and knowledge, many years of experience in this sector with the larger crowd, and share some of that wisdom that we are fortunate enough to get quite often as we research and diligence our companies. So with that, I'm going to turn it over to Andy Heyer, who's the CEO of Mistral Equity Partners, and let Andy really share some of his wisdom. Andy, please go ahead.
Okay, thanks a lot, Elon. I appreciate that. The one thing I will tell you is I wish it were 25 years. It's actually a little closer to 35 years. So I'm dating myself a little bit. But thanks for the opportunity to talk to everyone today about what we do and how it intersects with OurCrowd and potentially could be valuable to the OurCrowd community. A little bit more of my background and my team's background. I started out as an investment banker here in New York quite a number of years ago, but somewhere along the line ended up focusing on consumer and retail, first as a banker and then ultimately as a private equity investor. That journey went through a couple of big Wall Street firms to a boutique firm that I owned called the Argosy Group that I ended up selling to Canadian Imperial Bank, where I became vice chairman and built under their auspices a business that included a multi-billion-dollar private equity business. And that was through the 90s and into the early 2000s. And it was really the evolution of the industry over that, at that time, I guess, 25-year period that led me to start Mistral with a focus on consumer and retail. And that's what I'm going to talk about. The reason that evolution came about was twofold. The private equity business in the United States generally is now comprised of two major groups of funds. Either the gigantic mega funds like Carlyle and Apollo, who are in a sense a business unto themselves, or what I would consider to be smaller and mid-market funds that have an industry focus. The business has evolved such that it's very presumptuous to think you can run a fund that does everything from consumer to healthcare to energy, as well as people who only do one of those things. So with that realization, coupled with another fact, which is along, as I mentioned, sort of my journey into consumer, I would say there were 2 or 3 particular transactions that led me to believe that consumer was the best area for me to focus in with my team, because they were very demonstrable of the things that drive success in consumer investing. And I'm going to get into that in detail. Those 2 transactions were a company called Telemundo that dates back 25 years ago, and even though some of you may know it as a Spanish language TV network here in the US, I was involved in its formation about 25 years ago. That was my first introduction to the power of demography, essentially, demographics, in understanding how to invest in consumer businesses. The second one that probably had an even bigger impact was the formation of a company called Hain Food Group, H-A-I-N. It's actually publicly traded under that same symbol, H-A-I-N. It's actually called Hain Celestial. Elon referred to Celestial Seasonings, which was actually a company that Hain acquired. So I was one of the founders. In fact, I was the first chairman of the board of Hain Celestial, which started out as a very small investment, $3 million of equity by a handful of people back in 1994 to invest in the natural and organic food business in the U.S. We are now the largest natural and organic food company in the world, with over $3 billion in sales and a market cap of about $6 billion. The reason that was transformative for me was because it made me focus on what's known as psychographics, which I'm going to talk about in a second, which is how does what people are thinking about, or as their lives change their spending patterns. And quite frankly, 20 years ago, when we started Hain, and there might have been 6 Whole Food stores in the United States, the fellow I backed had the view that the way people consumed and purchased food was going to change when they really got focused on ingredients. And we were way ahead of the curve. So with those 2 things as background, let me tell you a little bit more about what we do. So on the backs of all that experience, we started Mistral in 2007 to make buyout and growth equity investments in mid-sized and smaller consumer companies. They could be consumer products companies, or they could be retailers, or in some sense we thought about consumer media companies, though those opportunities since we started really haven't presented themselves. But the second thing we did, which came from having been doing this for 25 years, is we created the fund is roughly $300 million. The fund is dominated on the investor side, not by the typical institutional investors, but rather family offices and wealthy entrepreneurs, companies, and management teams who made their fortunes in the same sectors that we are invested in. And the reason we did that is many of these people we have long-standing relationships with. They have their own deal flow, but not the time to pursue it. They have enormous expertise to lend to situations, but no outlet or no profit potential by lending out those resources. So we formalized what was basically an informal network that my team and I had developed over the years to harness those capabilities and to then focus them in on investment opportunities. And I'll give you specific examples of how we've done that in a minute as we go forward. So I already mentioned that two of the drivers are demographics and psychographics, and I'm going to spend more time on that in a couple of minutes, but I hope you got a flavor of that. In the case of Telemundo, we were looking at the rising spending power of the Hispanic population in the U.S., not to mention the mere growth of the population. And in psychographics, I use as an example eating healthier and focusing on the ingredients in your food and such. But the other things we added to the Mistral formula were the ability, since I am an investment banker by background, the ability to structure our transactions to enhance risk and reward as opposed to only investing a certain way. And I'll give examples of that later. But in some cases, we've made debt investments that had equity kickers. We've made preferred stock investments that were convertible. In fact, we made one investment that was where we bought into a large position in a public company, which typically isn't done by private equity firms. So we've structured our investments to make the best trade-off between risk and reward. I mentioned this advantage transaction origination and due diligence. That comes from the investor base as well as the value creation capabilities listed here. So here, this slide gives you a sense of the kinds of people, and this is only a subset of the people who are amongst our biggest and most influential investors. Many of these names may be familiar to you. In our fund, I've known Jay Schottenstein for a long time. To the people on the phone who know Jay or know his companies, he owns American Eagle Outfitters and DSW Shoes. Frank Bellotti, chairman and CEO of AFC, which is Churches and Popeyes, which is a fast food chain. Prior to that, he ran Days Inn. Donnie Deutsch, big-time advertising executive in the U.S. The next guy happens to be my brother. He was president of Coca-Cola Worldwide and CEO of Starwood. The Louis Dreyfus family, very big commodities traders, particularly in food-related commodities. Simon Properties, the largest operator of malls in the world. And Irwin Simon, the guy I mentioned earlier, who runs the Hain Celestial Group. There are many of these. There are many more of these type of people that we've done business with over the years who are active and engaged investors in our fund, and they comprise 40% of the fund, which is sort of unheard of in the fund business to have that much from non-institutional investors. But the fact is they have skin in the game, they're a source of deal flow, they have enormous due diligence help, and when you're a small fund, we're not Carlyle or Apollo, I can't afford to have 100 executives in residence. So we work with these people intimately, and because they have skin in the game, they add a lot of value. So this is the world of retail investing. This is not all of consumer, but it's retail, and this is kind of the way we look at retail. Okay, as pointed out here, consumer spending accounts for 70% of GDP, and it gives an enormous amount of retail opportunity. Everything from the mundane, like grocery, to more exciting things like fast food chains that are in new categories. But what we have done in the past is found the drivers of our interest. Back to that demographic psychographic thing. Which of these categories is money consumer money moving into as opposed to away from? Which ones of these are not dependent on mall traffic because they have what's known as omni-channel possibilities, meaning the consumer can access the product, let's say, in a mall if they happen to be in it, or online, or on their phone, or via a catalog. There's many different ways of reaching that consumer. And then lastly, not lastly, but another key component is we're looking for people or investment opportunities where there is a brand or a proprietary product that is not easily replicable and where those attributes can drive volume in an outsized way. So on this chart, for an example, I'll give you an example on this chart. For years, we have tracked the pet industry. The amount of money spent on cats and dogs in the United States is truly a staggering amount. I believe it is the only consumer category in the last 30 years that has never had a down year. It has grown year over year, every single year through recessions. We spent years looking for the opportunity to invest in the pet category. And we start with the assumption, that's sort of how we do our process, which is find an industry we want to get into, then try to identify opportunities, and then try to find an opportunity that has the best potential entry point for us. But that's just one example. So if you look at the next page, this is obviously the macro stuff that goes with it. It's not really worth, you can read this on your own, but typically, in a strong retail environment, and retail spending right now in the U.S. is generally speaking better than it was. There are growth opportunities, and growth opportunities that might fall into certain demographic categories. Over the past few years, our philosophy has been to invest, to really look what I would call on a barbell approach. We're looking on the one hand at luxury and affordable luxury, and on the other hand, value. We have steadfastly, generally speaking, stayed away from the middle. The middle class has been squeezed, and much of the, what I would call typical middle class spending in retail in particular has suffered. That would be sort of mid-priced restaurants would be a good example. Mid-priced but not discount retailers. Apparel, for example, would be good examples of people who have gotten squeezed. And if you think about it from the point of view of stocks that you might own or follow, the JCPenney's of the world have been challenged, whereas Neiman Marcus has done really well. McDonald's has been challenged, whereas Chipotle has been, an amazing experience. So, that's the way we look at things. So this is the way we actually look at companies as opposed to those macro categories. If you look at this chart, companies start in the bottom left corner. They tend to move to the upper left corner where they've created something, it's new. If they get a hold of, focusing it and fine-tuning it, they move into the left category, which is young but with high potential. That is the box we want to invest in. We want to invest in something where, again, I'm using retailers for the moment as an example as opposed to products, but it's as equally applicable to products, and I'll give you an example in a second. But where in a retailer, let's say, there is proven store metrics. In other words, we're not looking at companies that haven't figured out how to make money inside their four walls. We want to know that maybe they only have a dozen stores, but the stores are highly profitable. Now, and that there's enough white space for them to take that 12 or 20 or 30 stores and potentially have 100 or 200 stores. The company might not be making money yet because it hasn't hit what we call the inflection point. In other words, they might only have 15 or 20 stores. At the store level, they may be making tons of money, but they're building an infrastructure, they're building a home office, they're building systems that are costly, but are positioning themselves to handle that 50th store or that 80th store or that 150th store. And that's an investment in systems and people that run through the P&L, isn't necessarily capitalizable. So you might be investing in a company that's break-even or even a little bit worse, but you know fundamentally that the stores work. What you don't want to do is move into that. What you want to do is when that company we invested in the second box moves into the third box, that's when we want to sell it. And we certainly don't want to be involved as it goes back into the bottom right box of erosion of value caused by being a tired concept that no longer can engender enthusiasm because it's stale. So again, we're investing in the growth trajectory, not just a story. You know, this requires understanding, as I mentioned, consumer behavior. It's micro and macroeconomic forces. In other words, you can't, this is why the name of our firm, by the way, is Mistral. Mistral is the wind. We don't want to invest with wind in our face. We want to invest with wind at our back. And that was the whole theory, that was the theory behind our name. But, you know, what we're looking to do is, as pointed out here, is research and test retail economics to figure out who are going to be the winners, backed by that wind at the back that I'm referring to. So I think I might have hit on most of this earlier, but we do have these thematic approaches. Our structures are meant to be anything from buyout to growth equity to roll-ups to pipes. Pipes are private investments in public equities, and to balance that risk-reward. We are specifically looking to work on transactions where we feel we have an advantage, and that advantage may come from in-house knowledge or from our strategic partner, the Schottensteins, or from somebody on the management board. Again, it's all about, in this business, you know, unlike the tech business, where there's an expectation of a certain amount of failures, because that's the nature of it, the risk-reward is a narrower band here. You really don't want, you can't assume a certain number of dry holes. You have to assume, you know, you're going to have a certain number of singles, a certain number of doubles, and as one of my old partners used to say, every once in a while, one's going to roll to the wall, to use the baseball analogy, and you're going to do extraordinarily. But you don't go into these things thinking, you know, I may get wiped out on 5 of them, but on 2 of them, I'll make 100 times my money. It doesn't work that way. This is about, if it doesn't work, I make a bond-type return, and if it does work, I make, you know, 3, 4, 5 times my money, and if I get really lucky, something extraordinary. And again, the securities in which we invest, as well as the companies into which we invest, are selected with that in mind. So these are currently the themes that we have focused on in our existing portfolio, and some of them are a little dated because we actually exited a few that fell into these categories. But if you look across the top, what you're seeing is those big macro trends, whether demographic or psychographic. You know, maturing baby boomers, emerging millennial disposable income. Ethnic, always the case. Health and wellness gets more and more publicity by the day. I think everyone gets the idea. I think one of the other interesting ones is the sustained economic uncertainty, which is a very interesting psychological effect going on in the U.S., which is no matter how well people are doing, they don't feel nearly as comfortable as they might have 10 or 20 years ago in the same position. We then take these themes and then push them down into the industries, you know, that we have previously discussed. Right now, we are constantly interested in natural and organic. That doesn't go away. On-the-go products, very interesting for us. Pets, I mentioned. We previously, a few years ago, were very deep into private label, which had a huge growth spurt, which we took advantage of in the last recession. That's less of a focus for us now. We like what we call small ticket indulgences. That may be what appears to be an expensive product, but in the grand scheme, for what it is, but in the grand scheme of life, it's not a lot of dollars. A great example of that would be our investment in Jamba Juice, where buying a juice for $5, $6, or $7 sounds like an expensive thing, but if you're only doing it once a week, it's not going to break the bank. It's not, and people will always indulge. And then, as I mentioned earlier, the diverse channel retail strategy, very important for us. We really do not want to be involved in retailers that are dependent upon foot traffic or burdened by excessive rent. And the combination of both is just deadly. And I'll give an example of that in a second, where we think we found something very unusual. We then take those facts, overlay them on these sectors, and what falls out is what you see here. So using, again, as an example under the retail category, the small footprint, multi-channel discounters and luxury, but nothing in the middle, sort of an interesting barbell approach. You'll notice in pets, and we have an investment in pet supplies and durables, as well as one in grooming and boarding, which are both pet services. You'll notice pet food is not on that list. And pet food, meanwhile, is the biggest category within pet. And believe me, pet food is a phenomenally high-growth business. The problem, however, is the industry dynamics, which is it is dominated by 4 big multinationals, and including Nestle's and Mars. So to go into pet food, you have to make an early-stage investment, which may or may not pay off, in, generally speaking, extraordinarily high valuation in order to get in, and then hope you're the guy they want to buy. We have not liked that method of investing. We looked at an awful lot of pet food companies, but for the reasons I just said, we never could pull the trigger because the valuation to us was out of whack, and hence the risk-reward was out of whack. So we shied away. Using that as an example to show you that there are things that are easy, actually with a second layer of analysis, are easy to figure out why we haven't done. This, in fact, the Mistral portfolio since formation. You can see the color coding in terms of the number. The color coding shows the industry in the right bar, but also shows on a relative basis the size of the investments relative to the size of our portfolio. And by looking at those very small slices, what you'll see as you understand our portfolio better is that our larger dollar investments tended to be in the more mature companies, and our smaller dollar investments, logically, tended to be in the earlier stage companies, not venture-y, more growth capital, late stage, maybe pre-IPO, or call it last round before sale equity. But they tend to be smaller investments in terms of our portfolio size. The interesting thing, if you look at the right side of this page, and very few, some of these companies may be familiar to you all, is that in spite of their size, almost every one of these companies is in fact one of the leaders, if not the leader, in their business, even though they are not large companies. It's sort of an oxymoron, but we like to say we invest in the leaders in large niches. Shearer's was a very successful deal. We don't own it anymore, but that was back in 2008 when we thought the consumer was going to be very cost conscious given the recession, and we ended up buying the largest private label snack food company in the U.S., making it much larger and selling it very successfully. Jamba Juice, 4 Down, you might have, hopefully some of you have been to, or at least know about. It's the largest smoothie retailer in the United States with 800 stores. We also successfully exited that, though I still am on the board of the company. That company was a turnaround, where, in fact, it was a turnaround in which it's a great example of where we utilized our management board, and in that case it was Frank Bellotti, the guy who ran Churches and Popeyes, because it was an operational turnaround story, and if you didn't believe the turnaround story, you weren't going to make money. And Frank, having turned around Churches and Popeyes, was instrumental in us being convinced that not only could it be turned around, but the management there could do it. So below Jamba Juice, everything from Jamba Juice down, we currently own a piece of. Vino Volo and XpresSpa, you might have seen in airports in your travels. This is a great example of thematic investing where, unlike a mall, you have a captive customer. People, I'm sure I don't need to tell everybody on the phone, the airport is not a happy environment. It's a high demographic of people who are generally stressed out and, not happy. It's a great place to sell somebody a glass of wine or give them a massage. These two concepts are extraordinarily profitable at the store level. They're a little bit, in both cases, slightly past the inflection point, starting to make more money because the incremental stores are dropping profitability to the bottom line. They both have strong growth trajectories. And another interesting fact, which may be less apparent, is unlike virtually anything else in the airport, these two concepts are also very female friendly. And close to 40 to 45% of the traffic in the airport is actually female and not well served. And we felt that these would be both very appealing investments and have panned out, or in the process of panning out just that way. But I bring them up because they give you an insight a little bit into our thought process. Vino Volo has 35 wine bars. XpresSpa has about 45 spas. They both are benefiting tremendously from the upgrading of retail in the airport. Here, just to evidence what we're talking about, this is the way we score ourselves in terms of, do the deals that we've invested in actually fit the criteria that we espouse? And you can see here, that they do. We're constantly looking for that, as well as, whether or not we have some way of adding value to the situation. Here's another way to look at them also, which is, as I mentioned earlier, we don't just do vanilla. Our transactions have all sorts of flavors to them, whether it's a buyout, a recap, or growth equity, and our actual either control or transaction structure is variable. In some cases, it could be board control, total control. In other cases, like Jamba Juice, we owned 20% of the company at one point. We had 2 out of 7 board seats. We brought in a partner, a family from Canada that owns the largest frozen yogurt chain in Canada. They bought 15% of it. They had another board seat, and together we basically controlled the company. In another sense, if you look at Zack, which I'll mention for a second, if you haven't heard of it, if you have heard of it, you know exactly what it is. If you haven't heard of it, whatever you're thinking is not true. Zack is a furniture company. It is the fastest growing furniture retailer in the United States. And when we did that transaction, the Schottensteins invested alongside of us, in, not only through the fund, but incrementally by buying 20% of the available equity and putting somebody on the board, because they are one of the biggest furniture retailers in the United States through a company called American Signature, and they were able to add valuable assistance to the company. Zack, and then I'm going to try to stop talking here in a second, but I will say that Zack is another interesting story because of not only our advantage due diligence with the Schottenstein Group, as well as our value added from our investor base. But the other point of it is the furniture retailing business in general is a treacherous business. My partners will tell you, I swore I would never do an investment in the furniture business. And every time somebody in the past has said to me, this is different, I've said after 35 years, the one thing I know is whenever somebody tells me it's different, it's the same. So it turns out Zack is actually different because, and I urge you to look at their website, lovesack.com, they have patented furniture. A little bit hard to believe, but they actually have patented furniture. It is very high value furniture. They do it on an omni-channel basis where they have stores in malls that are only 1,200 square feet instead of the typical 20,000 square feet that would scare me to death. They have a product where the patent has been defended and cannot be duplicated. And this is actually a luxury product. The average ticket in this company is $2,500, and it is deliverable. Just to give you an idea, you should look at the website. We can deliver a 7-seat sectional to somebody's house via UPS. So all of the negative attributes of the furniture industry have been conquered by Lovesac, which is why it's growing so fast. So my last point before I open it up to questions would be, just in summary, consumer on one hand is very easy to understand because we are all consumers. We can touch products, we can taste products, we can wear products, and generally speaking, certainly in retail, you can visit the store. And if you can't visit the store because it's an internet company, what's now happened is you have a no tears return policy. So it's very easy to try products. Okay? Having said that, to do it right requires the understanding of consumer taste, consumer psychology, and where there are market opportunities via white space and barriers to entry like proprietary products. So our philosophy has been to go after companies that have proven metrics but a lot of potential left, where consumer acceptance has occurred, where financial metrics work, but what they need is capital to scale into that vast addressable market. And like I said, structure our transactions so that at a minimum, we can do okay, but at a maximum, we can do really well. So with that, I hope that was useful, and I'm happy to answer any questions.
Great. Thank you, Andy. I'll let you catch your breath. In the interim, I just want to push out a quick poll. Please be honest. You'll see it in your screen in front of you. There's still time to submit a question to Andy, so if you'd like to ask him a specific question, submit that through your GoToWebinar panel. We do have a few that have come through already, and I'll start with those. Just trying to organize them. So a lot of people asked if they could have the slides afterwards. Quite a few people, actually. Andy, are you comfortable sharing these with the audience?
Sure, no problem.
Okay. Can we talk about your investment thesis in XpresSpa? So you've said throughout the presentation you like the airport, you like that there's a captive audience. You also talk about this omni-channel sort of distribution. Can you talk about that one specifically?
Yeah. So XpresSpa is really, it's obviously not an omni-channel thing because you can't get a massage via the internet, which is one of the reasons we like it. You have to come to the store, and in their case, you've been brought to the store because you're traveling. As you know, post 9/11, the amount of time people spend in the airport has gone through the roof. There's actually a statistic called dwell time, which is the amount of time that elapses from the time you pass security to the time you actually set foot on a plane. And years ago, I'm sure we all remember running to a plane. You can't do that anymore. So dwell time, which is actually calculated and measured and published by the airports, has gone from 20 or 25 minutes to more like 90 minutes. And in those 90 minutes, again, let's think about who is traveling. It tends to be people with money, whether they're on an expense account or whether, it's a higher demographic than the street, to say the least. So they are people who are used to buying wine. They are people used to potentially having a massage or a manicure. What we have found is in that high-stress environment with time to kill, there is, I'm sure everyone's noticed this, the quality of the retailers in airports has gone through the roof. It used to be, McDonald's and a few no-name discount stores or people selling baseball caps. Now it's Ferragamo or Gucci. And the reason is who's in the airport and who's got money to spend. And it's the secondary reason is that the airports charge a percentage of rent. And so they want to run the ticket as high as possible because that's how they get as much rent as possible. So premium products, and in our case with XpresSpa, premium service, is an amenity that the the traveler wants and the airport wants to provide. So while many airports, we get space in airports through usually RFPs, requests for proposal, we are far and away the largest airport, the largest spa company in airports in the world. There isn't even a close second. And we're getting inbound calls from airports saying our local community is asking, who uses our airport a lot, is asking, why aren't you in our airport? Why aren't you in Tampa? Why aren't you in Phoenix? And that is opening up opportunities for us to rapidly expand the footprint of XpresSpa. The second thing I will tell you is there is actually a product opportunity at XpresSpa, which we are only now just starting to take advantage of, which is to sell, the creams, the lotions, the neck pillows, and other items that we're using in the spa that somebody is traveling and wants to take with them, and build out the brand even further, so that someday, maybe not anytime soon, but someday the XpresSpa brand may be available elsewhere for specifically personal care products related to travel.
Got it.
I hope that answers the question.
Yeah, great answer. We had a couple, actually quite a few investors ask about your interest abroad. Are you looking at deals from overseas? Have you made any?
Well, the answer is, broadly defined abroad, we have not, other than, I shouldn't say that. XpresSpa has 3 locations in Amsterdam, and the ability to, that is one of their big expansion opportunities, is to go international. We actually have spoken with Dubai, we've spoken with Heathrow, etc. So a number of our investments have the ability to expand internationally. Somebody mentioned, or I guess Elon mentioned earlier, our investment in Abe's. Abe's is a Jerusalem domiciled company. So that was really, our first non-North American investment. We do have a cell phone retailer in Canada, but, having run Canadian Imperial Bank, I view that as quasi-domestic.
Okay. It doesn't appear that you made any investments in apparel companies. Do you see any opportunities there? And one participant asks, do you see opportunities in compression apparel, like Tommy Cooper, the TV commercials have made popular?
Yeah. So we see a lot. It's very true. We have not done apparel. We have looked at a lot of apparel. On some level, I will tell you, fashion scares us. It changes very rapidly. So we have shied away from trendy apparel retailers. The kinds of things you mentioned would be appealing to us. We haven't seen that specifically. We have seen other apparel transactions that were geared towards performance or niche specialty activities that are mainstream activities but are niche markets. So we would and have seriously considered those types of things. None of them have panned out to date, but I wouldn't rule them out.
Okay. Couple questions about your investment model. Do you work to place strategic personnel into the companies you invest in?
In some cases, yes. In some cases, we're bad. I'll give you a few examples.
Great.
In Jamba, Jamba was a mess, to put it mildly, before we got involved. Having said that, just prior to our involvement, they recruited a new CEO who we kind of got behind. So while we didn't make that change, the change had been made by it's a public company, the board of directors, to bring in a guy who then realized he needed capital to turn the thing around. So that's what happened there. In other cases, in the case of Worldwise, our pet company, we replaced the entrepreneur with a very savvy senior executive who had run a major pet products company prior to our involvement. So it can run the gamut from, investing with incumbent management, investing with incumbent entrepreneur, to, I wouldn't say wholesale change. I'll give you another example, XpresSpa, since you brought it up before. XpresSpa was started by a married couple who had the idea. It was a great idea. They executed it up to a point. And about a year ago, we brought in a very seasoned retailing executive because the entrepreneurs, while they may have value in certain regards, they needed a professional management team to take it to the next level. I mentioned that inflection point earlier, but sometimes there are entrepreneurs in particular that can go only so far, and then they need real support and in some cases replacement.
While we're on the subject of your investment model, what's your investment bandwidth? Like, sort of what size investments do you make? How do you think about that?
Okay, so interestingly, I mean, the answer is a very wide band. So if you look at our chart, the last slide that's up there, you'll see this company called Spot. Spot's our smallest investment. We have a $3 million investment in Spot. If you go back all the way to the left side, when we did Shearers back in 2008, between us and our subsequent add-on investment, because we made a substantial acquisition 2 years into the deal, as well as our partners, our LPs, who added incremental capital because Shearers became a very large company, we had close to $75 million as a group invested in Shearers. So the answer is, the reason we structured the fund the way we did is it gives us the ability to spend meaningful amounts of time on relatively small investments, but at the same time, given our investor base, we have the ability to flex up to very large numbers if a situation warrants it. Jamba was 20 million, WorldLinks is about 35 with a few co-investors. We have a number of investments in the 30s. We have a number of investments in the 10 to 16 area. And like I said, the buyouts tend to be bigger. The growth equity investments tend to be more modest.
Question came through just recently about interest in food tech companies like Hampton Creek. Is that something that is on your radar?
We are actually very recently looking at a number of food. I've looked at a couple of food tech companies, actually one from Israel, literally in the last few weeks. So it's an interesting area. Again, we are not a classical venture fund. We don't fund startups in the purest sense of that word. So, in our case, if you really think about how I described our model, it would have to be a proven technology that at least has already had some meaningful adoption.
Great. I have a question for you. And, given you where you sit with your deal flow and the investments you made, is today's consumer, or how is today's consumer different than consumers in the past? Is there a changing face of the consumer right now?
Okay, how far back do you want to be the past?
Let's say over the past, say, 10 years.
Okay. Clearly the obvious first difference is e-commerce. There is instantaneous price comparison. People always like a bargain. People like to know that they're not overpaying. Even if they can afford to overpay, they like to know they haven't overpaid. So, this is why I go back to, I need to have a product that people really want that they can't get somewhere else. Or a service that I'm providing in an environment where they can't go somewhere else. This leads back to, your apparel question in a sense. How many guys out there are competing with the Gap, American Eagle, H&M, Century 21? I could go down. I could give you a list of 12 guys selling the same khaki pants. why do I want to be an investor necessarily in one of those companies? On the other hand, I'm the only guy who can, give you a massage and a manicure in the airport, and I'm also the only one who can give you a 3-seat sofa that can turn into a 7-seat sectional by you ordering more pieces online. So there needs to be real differentiation for there to be a compelling reason for us to invest. And like I said, it's driven by the consumer. The consumer is very smart and very cost conscious.
So, Andy, I'd like to ask a question. We spoke about this before we kicked off the webinar. When you approach a business, I mean, are you focused on finding a really cool product? Maybe it's juice, maybe it's furniture, or are you looking at more at the fundamentals of the business?
The answer is both, because it could be a really cool product with miserable fundamentals, and it's a very quick no. What may appeal to us as a consumer may not be a decent business. So, Lovesack's a cool product, but if they didn't have high gross margins, I would never have invested in it. I don't know if that answered your question. Jamba Juice is a phenomenal brand, with recognition way in excess of its actual size. And that to us was compelling. It also happened to be a turnaround, which was relatively, easy picking. So that was, pretty easy once we got through that. But it's a combination of all these things. It's macro. There has to be a macro. Like I said, wind in the face is a very tough way to live. Wind at your back is very powerful. Demographics will push you to success even if you make a bunch of mistakes. Add to that, like you said, a cool product with good fundamentals, and you have a recipe for success.
I think that's going to be it for questions tonight. Andrew Heyer, CEO of Mistral Equity Partners, thanks for joining us to talk about consumer and retail sector.
A lot of fun. Thanks for having me.
And thanks for everybody who joined us as well. I see that there are people who've signed up from around the world and attended from around the world. If you're listening to this after the fact and you're in Australia, we are working to try to get a more time-sensitive slot for you guys. Don't worry. Thanks, you guys, for all the input you've given as well. You'll get an email from me probably tomorrow with a link to the slides and to the recorded video. If you have feedback or there's another type of event you'd like us to host, please let us know. We're trying to do these and provide value to you guys. So your feedback is always welcome. And with that, it's Zack Miller and the rest of the OurCrowd team signing off. Be well, everybody.